But the impact doesn't end there. Many analysts warn that stress in Japan's bond market has the potential to ripple across the global bond market, including the US. That's because Japanese investors are the biggest foreign holders of US Treasuries, with more than $1.1 trillion in holdings, and have long been major buyers of US debt. But with yields at home now rising, those same investors have more incentive to bring capital back to Japan. That could mean scaling back on foreign bonds. If this trend continues, it could reduce demand for US debt. This comes at a particularly challenging time for the US. This chart shows Treasury auctions, or in other words, the supply of new government bonds hitting the market. In 2025, issuance is set to exceed $31 trillion, the highest on record. The US relies on both domestic and foreign investors to absorb this massive supply. If issuance keeps climbing while demand weakens, liquidity could suffer, making it harder for the bond market to function smoothly. So should investors brace for another major economic downturn triggered by a debt crisis that starts in Japan? Well, what happens next will largely depend on how the Fed and governments respond. If central banks sit back, yields could keep climbing, not because of strong growth, but because of liquidity is drying up, just as we've already seen happen in Japan. That would mean higher borrowing costs for governments, worsening deficits, and tighter financial conditions. We might just see a lag, and the shock we're seeing in Japan could actually ripple to the US, raising the risk of recession. But right now, we're beginning to see a sign of intervention. The Fed has already started cutting rates again in September after keeping them steady for 8 months, and has signaled it's open to further reductions. If we overlay 30-year yield on top, we can see that long-term yields often follow once policy rates begin to drop. By lowering short-term interest rates, the Fed makes cash and money market instruments less attractive. That can encourage investors to shift back into treasuries, helping to improve demand and ease some of the strain in the bond market. Ultimately, whether this develops into broader stress depends on whether the intervention is enough to improve this liquidity problem. If this support is enough, liquidity should gradually improve, yields could stay contained, and the economy might avoid a downturn. But if yields keep climbing despite these efforts, it could be a warning sign that risks are building beneath the surface. For investors, the takeaway is clear. Global bond liquidity and yields are now key risk indicators worth watching closely.